Investing in growth stocks can be lucrative for long-term investors with a higher than average risk tolerance. That's because growth stocks offer better than average potential for gains, but also come with above average risk. Today, I'll be revealing my top 9 growth stocks to buy right now in October. Also, I'll share my performance of my top growth stock picks so far in 2024. But more importantly, I'll touch on the 6-step investing framework I use to make investing decisions. So let's get into the details after the brief message for my sponsor.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
All right, my top 9 growth stocks to buy right now in October are, in no particular order, NVDA, Chewy, Amazon, Snap, Fiverr, Uber, Salesforce, PayPal, and Alphabet. Now, you'll notice what I have listed along with the names of these stocks are their valuations, their forward price to earnings ratios. And the valuations are very different than the market price. For those of you that already bought my book, you'll know the difference between the market price and valuation. The valuation measures what you're getting in return for the price that you're paying, whereas the market price only measures the price that you're paying, and it's an incomplete picture of whether or not something is expensive or inexpensive. It's not enough information. If I told you a stock is selling at $1,000, is it expensive or not? Your answer should be, there's not enough information, right? That's actually an exam question I ask my students at university. I give them a market price and I ask if it's expensive or cheap. And the correct answer is that there isn't enough information to determine that. You need to know what you're getting in return so that you know whether or not something is expensive or not. And that's a great example with NVIDIA. Its forward price to earnings ratio is only 30. And so if you've been following NVIDIA's stock price for the last year or 2 or 3, you may look at the significant gains and think to yourself, well, NVIDIA is too expensive, it's gone up too much. Especially this was true before the stock split when it was trading near $1,000 per share. But if you look at the valuation at a forward PE of 30, NVIDIA stock is not expensive. It's not expensive at all. And that's why I have it listed as one of my top growth stocks to buy because of its phenomenal performance and the relatively inexpensive valuation. And so that's why having a framework to look at stocks is important. And that's one of the factors I determine is valuation. Another factor I determine as critically important is the customer value proposition. What is the business selling to customers, and do customers find that a good value? And that's a great example to use. It offers its service primarily for free. And so users of Snapchat are getting a service that they value, and they're getting it for free. And all they have to do is watch a few advertisements every now and again. And how do you measure if customers think that they're getting a great customer value? Well, there are signs that give you evidence. For instance, Snap has several 100 million monthly active users and daily active users. Well, if you have several 100 million people using your service, then that's a great sign that you're offering a good customer value. Otherwise, they wouldn't be using your service, right? So those are some of the metrics I look at. Those are some of the factors I look at when I'm determining whether or not a stock is a buy, hold, or a sell. And it's not just one thing, it's a comprehensive thing that looks at all of those factors, weighs them all against each other, and makes a decision whether or not to buy, hold, or sell. And so it takes the guesswork out of investing for me. I plug it into my framework, and if my framework offers a positive conclusion for the investment, I give it a good rating. So here are those 9 stocks, and let's look at the performance so far. All right, so of my 9 growth stocks that I've recommended this year, 2 of them are negative. Snap at negative 35%, and Fiverr at negative 4.5%. The rest of them are positive, with NVIDIA being my best performing stock year to date in this list. It's up 144%, and I've reiterated my recommendation for NVIDIA stock several times because I get this question so often because NVIDIA's stock price has increased by so much. And when the stock price is increasing by so much, it gets a lot of attention from investors. It invokes a lot of emotion and invokes a lot of curiosity, a lot of concern, a lot of caution, anxiety, the fear of missing out, the fear of holding on to the stock too long. Should I sell and take profits? And so there's a lot of question and curiosity around NVIDIA stock. And so I've made a lot of videos addressing those questions and concerns. And throughout the year, I've said, look, sure, NVIDIA stock price is up significantly, but the company has justified those increases with the business performance. Those stock price gains have been supported by gains in revenue, in profit, in cash flow, in these fundamental factors that I consider when I'm evaluating a business. So it's not just that the stock price is increasing with no reason. The stock price is increasing because profits are increasing. And so it's justified. And so it makes the stock still inexpensive when the price is increasing, but profits are increasing by more than the market price. Okay, so now that we've seen the performance of the growth stocks, I want to compare it against the S&P 500, which is up 21.47%. And I want to see if you invested in my portfolio of 9 growth stocks this year, and I want to see how you would have performed against just putting your money in the S&P 500 index. Which one would have performed better? All right, so here I have listed the performance of my 9 growth stocks, and the portfolio of these 9 growth stocks, the return average is 24.65% year to date so far and I'm recording this video on September 30th. So far year to date, 24.65% return. That's a great return. I will take that any year. This is an unexpectedly positive year for returns, not only for my growth stock portfolio, but also for the S&P 500. This has been an above average year for investors, thankfully, and my portfolio has outperformed the S&P 500 by 3.18 percentage points. So if you would have invested in my growth stock portfolio instead of the S&P 500, you would have outperformed by 3.18%. Now, for most of the year, my portfolio has outperformed, but there have been months where it has underperformed. So I don't expect this outperformance to be every single month, but over the longer term, let's say a 5-year period, I expect my portfolio will outperform the S&P 500 because I apply my framework and I rule out a lot of stocks that shouldn't be invested in, those that are overvalued, those that shouldn't be considered because of poor business prospects, no reason for their valuations other than maybe they are included in an index, or maybe they are hyped up by some investors and considered when they really shouldn't be. So I will continue updating this portfolio for the rest of this year. Hopefully this outperformance continues, but it's great that it has been outperforming up until now. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.